Most real estate investors lose money on their first deal, not because they picked up the wrong property, but because they never ran the numbers before they called a lender. I'm Aidan, and I funded hundreds of millions of dollars in hard money loans. And in this video, I'm going to show you exactly how to calculate what a hard money lender will give you before you ever pick up the phone. Grab a piece of paper because we're going to work through real numbers together. Here's what we're going to cover. First, how lenders decide the maximum they'll ever lend on a property. Second, the real formula they use to calculate your actual loan amount. And third, the number most beginners completely forget, and it's one that will catch you off guard if you're not ready for it. So by the end of this video, you should be fully confident in running your numbers for deals. So let's start with the most important number in hard money lending, the after repair value, ARV. It's what your property will be worth after you fix it up and it's ready for resale or refinance. So hard money lenders don't care as much what you're paying for the property today. They care mostly on what it's going to be worth when you're done with it. That's the number they base everything back off of. So most lenders will lend you somewhere between 70 to 75% of ARV. That's their ceiling, the most they'll ever put into a deal, no matter what. Let's use a simple example. Say your after repair value is $100,000. At 75%, the maximum a lender will give you on that deal is $75,000. That's the box you're working inside of. Everything else has to fit within that number. Now, why 70 to 75%? Here's how lenders think about it. They expect you to make around 15% profit on the deal, add their 75%, and you're at 90% of the sales price. The remaining 10% covers your realtor fees, carry costs, and anything unexpected. That buffers what makes them comfortable putting their money into the deal. Now, here's where most people get confused, because the ARV cap is not the only thing that determines your loan amount. Every lender also has a second set of numbers. You'll hear things like 90-100 or 80-90 or even 80-80. Let me break down exactly what that means. The first number is how much they'll lend to you on the purchase price. The second number is how much they'll cover on your rehab costs. So 90-100 means they'll lend 90% of what you're paying for the property and 100% of your rehab costs. Let's run through a real life example. So let's say you're buying a property for $60,000, your rehab budget is $20,000, and your closing costs, title, escrow, lender fees, insurance, let's just estimate at $3,000. So with a 90-100 lender, they'll give you 90% of $60,000. That's $54,000 towards the purchase of the property. You're covering the other $6,000. They give you 100% of that $20,000 rehab. You're putting in nothing there. And closing costs, that's always on you. So that's $3,000 out of pocket. Total loan is $74,000. Total you need at closing $9,000. And it fits within your $75,000 ARV cap, so you're good to go. Now let's look at what happens with a less experienced borrower who only qualifies for 80-90. This is the same deal and same property. They lend you 80% of that $60,000. That's $48,000. Now you're covering $12,000. They lend you 90% of that $20,000 rehab. That's $18,000. Now you're covering $2,000. Closing costs still come out of your pocket at that same $3,000. Total loan, $66,000. Total you need, $17,000. Same property, same deal, $8,000 more out of your pocket, just because your terms weren't as strong. This is why credit score and your experience matters. The more deals you've done, the better terms you'll qualify for, and that directly impacts how many deals you can do at once. And look, if you're not sure what terms you qualify for right now, that's exactly the kind of conversation we have with investors every single day at RSC Private Lending. We'll look at your deal, run through the numbers with you, and tell you exactly where you stand. No pressure, no guesswork. If the numbers make sense, we can get your loan funded in as little as 7 to 10 days. The link is down below. Just reach out and we'll take a look. So here's the number that surprises most first-time investors: carry costs. And this one is important, so don't skip it. While you own the property, you're paying every single month. You've got the interest payments of the loan, property taxes, insurance, and if it's in an HOA, that too. There's two ways on how to calculate that monthly interest payment. We'll start off with Dutch interest, and it's actually the simplest. So take your loan amount, multiply it by your interest rate, and divide it by 12. That's your monthly payment. So if your loan is $1 million at 10% interest, that's $8,333 a month. If you're holding that property for 6 months, that's $50,000 coming out of your pocket before you ever sell it. For non-Dutch interest, the principal is the same, but the interest accrues only on drawn funds. So if that $1 million loan consisted of $800,000 towards the purchase and $200,000 towards the rehab, then interest from day one only accrues on that $800,000, which would be $219 per day or $6,666 per month. As you start pulling from your rehab budget, your total drawn loan amount goes goes up. Therefore, your interest payments go up as well. If you draw $50,000 from your budget, then your payment would go to $7,083 per month. If you drew $165,000 out of your budget, then it goes up to $8,041. The interest adjusts daily to make sure you are being charged fairly based on the funds used so far in the project. Although more complex to calculate, it is definitely the preferred and most beneficial interest accrual type for real estate investors. If you want to understand more about the difference between the two, head to my page where I have a video dedicated to breaking down the difference between non-Dutch and Dutch interest. So again, the faster you close the deal, the lower your carry costs. Hard money rates are generally higher than conventional rates. This encourages you to finish the project as quick as possible. And really, the faster you finish the project, the lower your carry costs. Speed is money in fix and flips. So here's how to think about your total cash needed going into the deal. 1, the gap between the loan and the purchase price. 2, your closing costs. And 3, your estimated carrying costs for the full hold period. Add those 3 numbers together. That's how much cash you need to not just close, but to survive the deal and make a profit. So to recap, hard money lenders base their max loan on 70 to 75% of ARV. Your actual loan depends on your purchase price percentage, your rehab coverage, and where your total falls inside that cap. And your real cash needed includes the gap, closing costs, and the carry costs. All 3. Run these numbers on every deal before you call a lender. That's what separates investors who do this long term and the ones who get burned out and quit. If you got a deal you want to run through, or you want to know what terms you'd qualify for, click the link below and I would be happy to chat through it with you. We'll see you in the next video. Thanks.